The Sustainable Development Goals, or SDGs, were adopted by all United Nations member states in 2015 to end poverty, reduce inequality, and build more peaceful, prosperous societies by 2030. Many of the global challenges to development are especially salient for the children and youth. It is their future that depends on how well these SDGs are adopted. Where do our children or the youth stand today?
There are still a lot of kids
that can't go to school
because their families
can't afford their education.
Other kids have to walk a long distance
and even cross rivers and climb mountains just to go to school.
A lot of kids cannot go to school because the parents don't have money.
People are using up the world's resources
without thinking of the consequences,
like global warming. We have a lot of natural disasters
like super typhoons and forest fires
that destroy the livelihood and homes of many people.
People's waste are reaching the oceans,
killing turtles, fishes, and other marine life.
The number of animals are getting smaller and the food supply is getting smaller.
Why do you think their numbers are getting smaller?
Because they're getting endangered. The people have been cutting the trees in their habitat.
A lot of people are getting sick,
especially because of COVID-19. Everyone is affected.
Yung ibang people hindi makapunta sa hospital pag sick sila.
What is the ideal future for our children?
Sana lahat ng bata ay mabigyan ng pagkakataong makapag-aral.
I dream of a future where no kid gets left behind.
I hope people can start doing their part in saving the earth
by doing simple acts
like recycling or bringing our own water bottles
for our beverages.
Our family has learned not to use plastic bags, and I just hope others learn how to do that too.
Sana walang bagyo na makakasira
ng mga pinaghirapan
ng aming magulang.
I wish for a greener environment.
Less pollution.
I hope governments and people work together
so we can fight any virus
or any sickness
that comes our way.
I hope that everybody has an access to medicine and proper nutrition.
Sana may pagkain mga pamilya para wala nang maglimos.
All of the kids have to stay healthy. We dream of a future where every child thrives.
Every child lives in a clean environment.
And every child has a fair chance in life.
Now more than ever, we must work together
to make the world a better place,
to ensure healthy lives, improve access to education,
to combat climate crisis.
Aligned with the Atram's mission to engage, inspire, and collaborate
to build a financially secure future,
we are committed to building that future where no one is left behind.
We have adopted 3 out of the 17 SDGs,
aiming to make a positive impact,
as well as ingraining more responsible
and sustainable business practices within Atram.
At Atram, we value our children's dreams. Let's make it happen for them. Through the Atram Sustainable Development and Growth Fund, we'll invest in companies that embrace sustainability and believe that this is key to a better Philippines and a better future for us and our children.
If we be nice to our planet Earth will be nice to us.
Invest to thrive. Invest together.
Hello and good morning, everyone. Thank you for joining this week's episode of Atram webinar series. I am Nicole San Luis, Senior Manager for Business Development and your host for today. Today's session is dedicated to Atram's best performing mutual funds and UITFs for the first half of 2021. Stay tuned to learn more about these funds and how Atram's experts navigated the volatile market to achieve these results. Before anything else, I'd like to let you know that this session will be recorded and that copies will be disseminated within the day, as well as posted on all our social media platforms. Also, please don't forget to visit our website, atram.com.ph, for more detailed information about all the funds that we have to offer. If you have any friends who you think would like this webinar but are unable to attend, please feel free to share the YouTube replay of this session and visit our YouTube channel, Atram Studio. We would like to invite you to join Atram's official Viber community group, that's hashtag AtramPH community, to stay updated on the latest announcements, advisories, and reminders. Kindly scan the QR code or visit the link on your screen and get a chance to win Atram merchandise. We would like this webinar to be as interactive as possible, so please don't hesitate to send your questions in the Q&A tab all throughout the webinar, as we have a special surprise for all of you. Each question you send is a raffle entry for a chance to win Atram merchandise. Winners will be announced at the end of the webinar, so make sure to stay tuned until the end. We will also be sending a quick feedback survey after the webinar, so we do hope you can share your thoughts with us about our session today and how we can improve on our webinar series. Before we begin, I'd like to reiterate and remind everyone that when it comes to investing, the past performance is no guarantee of future results. So now, without further ado, let's start. We will be joined by Atram's experts to discuss our top-performing mutual funds and UITFs. Our first research speaker this morning is Atram's Head of Equities Research, El Jamil. El has been with the industry for 6 years, covering various sectors like power, utilities, infrastructure, cement, property, banks, and conglomerates. Also here with us today is Devi Ulpo, Atram's Fixed Income Senior Portfolio Manager. Devi was awarded the second most astute investor in Asian local currency bonds for the Asset magazine for 2 consecutive years, both in 2020 and 2021 respectively. Also joining us today is Atram's Multi-Asset Senior Portfolio Manager, Ivan Ante. Ivan currently manages Atram Public Multi-Asset Funds and several of the firm's wealth mandates. And last but definitely not the least is a resident speaker and Atram's Product Development Manager, DJ De Jesus. As a product development manager, he identifies potential new product opportunities to continue Atram's legacy of innovation. Now that we have introduced members of Atram's competent and experienced team, we will begin with today's discussion by taking a look at the performance of the Atram funds and their ranking against the benchmark and other peers. So now let's take a look at our best performing mutual funds for the first half of 2021. First on our list is the Atram Alpha Opportunity Fund. Historically, the fund has been the least volatile in the whole fund industry as we continue to pick quality companies that are not subject to the volatility and scrutiny of foreign investors. The Atram Alpha Opportunity Fund has generated an 8.8 year-to-date cumulative performance return, outperforming its benchmark by 8.49%, and has ranked first in peso equity mutual funds in the Philippines. At this point, I would like to call on El Jamil to explain more about the funds and his strategies. Hi, El. We just have a couple of questions for you. I'm sure our viewers are interested to know. Please do share the strategy with us and what really sets the fund apart from other equity funds.
Yeah, thank you so much, Nicole, for that introduction. And again, thank you everyone, to all our viewers and listeners. Thank you for the interest. And yeah, so as Nicole said earlier, Alpha Opportunity Fund has been our best performing mutual fund with an 8.1% return as of the end of June. And Alpha Opportunity is a very clearly defined strategy. It invests in small to medium cap companies that have a higher growth potential than the market while still meeting Atram's risk criteria. And part of the strategy is also to identify those that have a high probability of inclusion to major indices, whether it be through the local PSEI index or foreign indices like the MSCI or FTSE. We've already seen this happen for a couple of companies already. So this Wilcon, the home improvement company, Converge, the third telco that we're seeing right now that's focused on fixed broadband, excuse me, and Bloomberry. Bloomberry is the company that owns Solaire. And so this strategy, together with the fundamental analysis framework that we have in place, is what sets Alpha Opportunity apart from the other funds. And I think our past results from our 5-year performance, our year-to-date performance, or even our performance over the past year uh, says that this system and this strategy works. Year to date, we've outperformed our benchmark, and over the past year, we've also outperformed both the benchmark and the PSA. So it says that both the strategy and the system in place not only works in bull markets but also during crisis times.
Okay, so thank you, Elle, for sharing to our audience your views and strategies relating to the Atram Alpha Opportunity Fund.
Sure.
Next on our list is the Atram Corporate Bond Fund. The fund is designed to generate regular income, streams, and capital appreciation by investing primarily in Philippine peso corporate fixed income securities by Philippine companies. The fund has delivered a YTD return of 1.46% and is ranked number 1 peso fixed income for corporate fund. This fund is managed by Miguel Liboro and Devi Ulpo. Hello, Devi. Nice to have you back. As co-manager of the fund, I just have a few questions for you. What are the opportunity sets that Atram Corporate Bond Fund invests in? And what do you think sets your fund apart?
Sure. Thank you, Nicole. So really, the corporate bond fund is a product that balances growth, consistency, and liquidity. So in terms of investment securities and opportunities, we're looking for strategic position in companies with strong balance sheet, healthy liquidity, and adequate coverage as credit fundamentals in terms of what we're trying to select, right? So in terms of structure, the fund is structured to be able to take investment opportunities on whether it's a rising or a lower rate environment by buying corporate bonds. So around 70 to 80% of the portfolio is really in a corporate bond. And around 20% is in government bond, but that's more about to take on liquidity management for the fund. Basically, the target beneficiaries of the fund are investors with a moderate conservative profile. Those investors that are really trying to just invest for income, high yield, and lower volatility and capital appreciation. So again, the corporate bond funds focus is really to deliver growth, consistency, and liquidity for its investors.
Okay, thank you so much for that, Devi. Moving on to the next best performing mutual fund on our sleeve is the Atram Asia Plus Equity Fund, which has generated a 5.92% return. The fund's primary investment objective is to invest and reinvest mainly in a diversified portfolio of high-quality equity securities listed on the Philippine Stock Exchange and other international stock exchanges, and in high-quality equity securities listed in other countries, and thereby provides investors returns consisting of dividend income and capital growth through investments in such securities. The fund is designed for those who desire high growth, with high risk. Now, let's call on none other than the fund manager himself, Ivan Ante, to share with us his strategies, as well as to help our audience in their investment decisions. Hi, Ivan. Good to have you back here. Thank you for joining us.
Hi, Nicole. Thank you. Happy to be here and happy to share our views to our audience.
Given that the Asia Plus Equity Fund has managed to generate a 5.92% return, how were you able to deliver such high returns, and where do you attribute the performance?
Well, thank you for that question. And obviously, this is not only timely, but also very important since everyone here is Filipino, or at least a lot of us here are Filipinos who are invested in Philippine equities, right? Philippine equities is pretty good, but I guess I just want to start off with you mentioned that this fund is more aggressive or more risky by the virtue of its being equity, right, and being being international equities. But from our perspective, actually, it's less risky because it's diversified across countries and you diversify also across currencies, right? So having said that, to your question, where did we get our returns? So the first half was a good half in general for risk assets globally and in Asia in particular. North Asia, China, South Korea, Taiwan continued to outperform the first quarter as expected because they were coming out of the pandemic at a higher ability to manage it. At the same time, their export-related economies are doing well. At the same time, in the second quarter, while China started correcting in February, ASEAN joined the rally in the second quarter for decent returns. For our fund, our strategy of selecting countries paid off since we were able to calibrate the portfolio into underweighing Chinese equities by probably March. And as you all know, Chinese equities are currently still correcting from high levels, especially tech and education sectors. So we were underweight there. And we rotated now to countries where there are now more prospects for returns. Like for example, Philippines, right? We were able to overweight Philippines on time for that rally from 6,000 to 7,000, as well as those countries that we really like. For example, we are underweight in Vietnam. We're overweight in Thailand, in Singapore. So that helped our portfolio. Basically, just to summarize that, we were able to achieve diversification from each other. Because if you're invested lang in Chinese equities, right, or Philippine equities, you can't really even though if you're a good active fund manager, if your broad equity indices are down, it's very hard to get positive returns. But we were able to calibrate our portfolio so that we avoid those that will underperform and we can overweight those that we think will outperform. So, for our fund, we consistently update our systematic country allocation. Kasi diba, you have, for example, 12 countries that you're gonna invest in. So what are the methods? What is the method that you do? So what's the secret sauce? I won't discuss the total secret sauce because that's our secret. But we have a two-step process where we combine three main factors. So first one is macro fundamentals and earnings momentum. So that's very important for equities and country allocation because as you all know, countries in Asia have different development paths. Some are rich, some are poor, some are in the middle. So you have different factors that are important. The second factor is sentiment and flow drivers. Aside from having views, we look at where are they really putting their money. Is their money where their mouth is, basically? Are the foreigners coming into this country or not? And what's the sentiment? Is it negative sentiment because of Delta variant, etc.? And lastly, when we combine those two factors, that's the first step. And then after that first step, we overlay the valuation. So how is it? What's the valuation now compared to to other countries. Like for example, how's the valuation of PSEI versus Shanghai Composite or the SET index, and then at the same time you look at the absolute valuation against its history. So we combine that and then we pick which we are overweighting and underweighting and remaining neutral. And I can discuss later if you have questions how we are positioned.
Okay, thank you, Ivan. Thanks for that very insightful explanation. So now let's jump to the Atram Unicapital Diversified Growth Fund, which you also manage and has generated a return of 0.43%, outperforming its benchmark by 2.79%. If we take a look at its performance against peers, the Unicapital Diversified Growth Fund is ranked first. Very impressive performance. So I just want to ask, and I'm sure our audience are also curious, how are you able to generate such returns and what are the fundamentals of the Atram Unicapital Diversified Growth Fund strategy?
Thank you for that. It has been a very volatile year last year and also looking like this year also. I think actually that this year is a harder year for us to manage portfolios. But the beauty of a multi-asset approach and a diversification approach in general is that if one asset class, let's say equities or the stock market, is not doing particularly well, there are other asset classes that we can put our money in, right? For example, like what I mentioned in Asia Plus, Philippine assets or Philippine equities were down relatively compared to other Asian countries. So we were able also to not only invest in Asian equities, but global equities for this fund. So we were able to avoid the downturn in equities for Philippines while we get the positive returns globally. At the same time, on an asset class basis, I mentioned that Philippine equities was down, but global equities were up. For fixed income naman, largely it was negative returns the first quarter. But because of our manager, Devi Ulpo, for our fixed income fund, we were able to consistently get positive returns na after the first quarter. And that enabled our fixed income position to generate positive returns for our portfolio. So it's basically if you're negative in one asset, we have the ability to go to where we think there are good or prospective returns are better, catalysts are better, management of the virus is better, valuation is better. At the same time, it doesn't mean that we are very static in how we manage our portfolio because a lot of us know it's very dynamic. There are opportunities because of volatility. Philippine equities goes from 6,000 to 7,000 and now 6,400. So there are opportunities there. There are opportunities also for active management in Philippine equities. And you can see how L is really doing that super well. And that we also work with them to get that return. So we do not only diversify across geographies, across currencies, but also selection. Our selection of managers. So we seek the help of Devi and L for our portfolios so that we can, get that active management in the selection side also. So to work for us. So all in all, that worked for us. It's gonna be a very different second half, and I can discuss that later also for Q&A.
Okay, thank you so much, Ivan. And I just also want to remind our audience to just please continue to send in your questions and for the Q&A portion, so that our fund managers can answer them. So now let's move on to our best performing UITFs. I'd like to call on our product manager, DJ, to tell us more about these funds. First up is the Atram Global Technology Feeder Fund, which has already generated a whopping return of 19.57%. If we were to compare the fund against its peers, the fund ranks first in the thematic peso equity funds. Ranking second on the list is the Atram Global Financial Feeder Fund, which has delivered a return of 16.48%. Meanwhile, the Atram Global Consumer Trends Feeder Fund bagged the third spot with a return of 12.58%. Okay, DJ, let's tackle this one by one. As we discussed, the Atram Global Technology Feeder Fund first. So the Global Technology Feeder Fund generated a 19.57% return and is ranked number one among the thematic peso equity UITFs. So what do you think sets this fund apart?
I think that's a very relevant question, di ba, Nicole? Kasi ang dami ng tech funds out here in the Philippines na na-launch na sa market. And why we continue to outperform with this fund is really the philosophy of our target fund, the Fidelity Global Technology Fund. They really believe in investing in quality companies that can sustainably prosper. Kasi di ba, ang daming advancements in technology, but the ones that are able to win because they drive the revolution and not because they are the winners of the revolution. Yun yung focus ng target fund na to. And you'd notice the fund is not really too heavy on big tech stocks like Microsoft, Facebook, Apple, Amazon, Google, Netflix, or basically software. In fact, in the top 10, you'll see more semiconductor companies. And this is because chasing the winners can be very volatile, especially in these volatile times, like Ivan said. Like what we're seeing with the Beijing regulatory crackdown earlier in this year, and with the focus on recovery earlier in the year, where we saw rotation out of software names. So overall, the fund really has seen a steady rise, and that's really great for investors who are not happy with seeing their fund values go down.
Got it. Thanks for that very insightful answer, DJ. How about for the Atram Global Financial Feeder Fund? Can you share with us the fundamentals of the Global Financial Feeder Fund that has led to this very promising return?
Well, financials is a big beneficiary of global recovery. And sabihin na lang natin, medyo takot tayo with the Delta variant now. But based on what the Fed said yesterday, they upgraded their growth forecast for the US to 6.5% growth, diba? And that speaks to the strength of the global economy and the recovery story talaga. I spoke at length of this in the previous webinar about this particular fund, but basically banks, insurance companies, asset management like Atram, and even fintech can really benefit from the recovery and the resulting rising interest rates. Banks and consumer finance companies get higher interest rate margins because of the higher rates, and they're able to charge higher on their loans. Insurance companies and asset management get a boost because most equities in a recovery start rising, diba? And fintech is just a growing area with more people consuming goods via e-commerce. And GCash is a big beneficiary, one of our partners. So there's a lot of positive drivers for the financial sector, and it's definitely the main beneficiary of a recovering world that we're seeing right now.
Thanks for that, DJ. Let's move on to Atram's Global Consumer Trends Feeder Fund. Can you share with us your thoughts on the fund strategy and where do you attribute the performance?
Well, much of the success of the Global Consumer Trends Fund is really being proactive. They really chase the next trends in our consumption. It's a bit more volatile than the tech fund, but the fund really knows when to shift gears for the most part. If you go back to October of last year, there was more hope for the recovery, and they really reduced some of their digital lifestyle holdings, which were the winners in the pandemic, as the webinar for this fund was featuring. And they moved it to theaters, resorts, and also travel destinations. Basically, those that benefit from a post-COVID world. And another sector rotation came in a couple of months ago, and their more tech-related holdings started to bring more returns for the fund. Really, the success is in the fact that e-commerce and video gaming are here to stay and will grow exponentially, but also recognize that there are some short-term trends like cars, people buying cars, traveling, and going to theaters now. Like you probably watch Black Widow, right? A lot of people in the US watch Black Widow in theaters already. So that will also begin to work. It's that balance of having that long-term play with the digital lifestyle and also having those short-term opportunities that they really put into the fund.
Thank you, DJ. Moving on to our next fund, this fund seeks to achieve long-term capital growth by investing in equity securities of companies in the Asia-Pacific region, excluding Japan. Want to take advantage of the Asia growth story? Then invest into the Atram Asia Equity Opportunity Feeder Fund. This fund has delivered a return of 12.78% and is ranked number 1 among Peso Asian Equity UITFs. So what are the opportunity sets that Atram Asia Equity Opportunity Feeder Fund invests in, DJ?
It's not in the name of the fund, but actually this fund is invested into quality dividend-paying stocks. And the fund pays regular income as it's invested in a lot of these quality companies. It has really 3 places it invests in: cyclicals, quality at a reasonable yield, and defensives. Cyclicals really benefit when the economy is going up, and you saw that with the fund. That's why the fund has been performing really well. And that's what we saw with the global recovery. They also have quality at a reasonable yield. So these are quality franchises that continue to be sustainable moving forward, and you could thus rely for good income. And you also have defensives which shield you from a lot of the market volatility. And that makes the fund also less risky. So overall, Asia has the best chance to provide for more growth in the coming years. The demographics of a younger generation, diba? And workforce allows for the region more room na umakyat, diba? So, but we know how risky it is with all the markets being hit with the bad news of the US-China trade disputes or the Beijing regulation crackdown. So taking a more defensive approach overall on Asia helps still get competitive returns, but with less risk.
Got it. Thank you for that, DJ. Next up is the Atram US Multi-Asset Feeder Fund, which also ranked number 1 and has delivered a return of 8.86%. The fund aims to achieve income and long-term capital growth by investing in debt and equity securities in the US. So what are the top contributing sectors during the first half of 2021, DJ?
One, let's just say, ang lakas ng US this year, diba? And before we go to the sectors, I want to also note that the fund managers of this fund, Allianz, and the target fund, Allianz Income and Growth, they're stock pickers. And the sector exposure is just a byproduct of the overall selection. This fund has a static allocation of 1/3 in each of the asset classes, being equities, high yield, and convertible. So selection talaga yung magiging basis as to how this fund is performing. In equities, the primary driver of the performance is communication services. Diba? We tend to use a lot of our cell phones and our smartphones now that the mobility is not just there. And even with Biden's infrastructure plan and strong online advertising demand, this is an area that's really strong. Industrials and financials, which I mentioned a while ago, really also benefited in the first quarter because of the recovery story and rising interest rates, respectively. Healthcare also benefited on the back of the concerns of the Delta variant. It's also invested there. And in the convertible space, energy and transportation also provided outperformance, benefiting again from the recovery. It also has exposure to healthcare, which also benefited. And on the high yield space, they likewise benefited on exposure to energy, again, theaters and entertainment, and automotive support services. So these are also the industries that benefit from a recovery. They shifted overall in both equities and convertibles to technology in the second quarter, and this also helped.
Mm-hmm. Thanks, DJ. As you said, it's a lot. Na?
That's a lot.
Yeah. Next is the Atram Global Multi-Asset Income Feeder Fund, which again ranked number 1 among dollar balance fund UITFs and accumulated a return of 7.9%. For the benefit of our viewers, can you please share with us the driver of the allocation of the fund and what makes it different from other global funds?
I'm glad to. The fund is really invested in all types of assets that really pay income, which include fixed income, equities, and all the hybrids as well. And the fund takes a risk-based approach to income. They don't want to stretch for the highest yield, so hindi siya maging super taas. But they provide for solid price return. So yung fund values mo, umakit din. Other than the income that you get, you also get solid price return. And it really shows the fund is up roughly 4% on price return alone. With the approach, all of its strategies per asset class have really contributed to the positive performance. Like no single asset class was down for this particular fund. So galing. The main driver really for the allocation decision to different asset classes are based on the individual views of each asset class based on the economy and their outlook. So positioning today has not really changed much from late last year with a focus on equities and high yield, lalo na how strong the recovery has been. And the fund is really actively managed. So we can be comfortable that the fund managers would take into considerations current developments in the market.
Thanks, TJ. Appreciate you giving that level of confidence also to all of our viewers. So last but definitely not the least, the fund that was just launched earlier this year has already delivered a promising return of 6.16%. The Atram Philippine Sustainable Development Growth Fund. So we at Atram support the UN and the SDGs through the Atram Philippine Sustainable Development Growth Fund. The fund focuses on investing in Philippine companies that make a direct impact to the sustainable development and growth of the Philippine economy. So the Philippine Sustainable Development Growth Fund delivered a promising return of 6.16%. How are the Philippine companies in terms of sustainability integration? Are they comparable to the rest of the region?
Actually, that's a very hard question to answer. And it's really because sustainability integration is tied to standardizing what are the definitions of sustainability and reporting that as non-financial data, as mga annual reports sa mga companies. And sustainability integration usually begins with that reporting. And in this area, most of ASEAN is still in the infancy stage with regards to reporting sustainability because they're only starting to require these sustainability reports over the past 3 years. Based on what we have observed, though, Singapore and Thailand are a bit ahead, mga 2 to 3 years ahead in terms of sustainability reporting. And then here in the Philippines, we might be a bit ahead of the other ASEAN markets. And if you want to compare to Europe and North America, who've been, the forerunners of this, make sure the gap is still more evident. But with that said, that has a lot of opportunity moving forward. And it really engages the ability for us to talk to our, companies and say, you guys need to start looking at sustainability. You need to start looking into our future. And we're seeing also with a lot of discourses with a lot of our fund managers that it's becoming even more important here in the Asia region that we look into sustainability. So there's a lot of areas for growth in this area. There's a lot of potential growth also in the markets. So this fund is, very primed to do well.
Thank you. Thank you for that, DJ. So I guess that's it for top performing mutual funds and UITFs for the first half of 2021. So Atram has a wide range of investment products and our capabilities span across several asset classes meant to service the different investment objectives of each individual. And with these, it is with great pride that we announce that Atram has recently bagged 5 industry awards for 2021. The Best Local Fund House in the Philippines, given by Asian Investor. The Fastest Growing Fund Management Company in the Philippines, given by the Global Banking and Finance Awards and by the Global Economics Awards. and the most innovative mutual fund offerings, again by the Global Economics Awards. We have also been awarded the editor's triple star by The Asset for integrating ESG, which is environmental, social, and corporate governance, in our investment process. For today's session, we hope to have somehow assisted you to hashtag Take On Tomorrow by investing your hard-earned money with an award-winning fund house. For more information about Atram, please feel free to visit our website. That's atram.com.ph. So at this point, we would like to move on to the live questions from our audience. We actually have several questions coming in. Let me get to them. Can we please ask Yvonne for multi-asset, and L for Philippine Equities, and Devi for fixed income? Hope you could please share your market views for the rest of 2021, and how does this affect your strategy and the target returns for the rest of the year?
I guess I'll be one to start first, and Debbie, and then I can summarize as multi-asset.
Yeah, sure. Okay, so for equities, we think that 2021 will definitely be better than 2020, although it won't be as much as what we initially expected earlier in the year. As we all know, we reverted to ECQ the third week of March, and that lasted for about a month or so. So this already bucked our expectation that there will be a gradual improvement at the start of the year. This led us to revise our earnings forecast for this year, lower to 30% from 45%. So I want to contextualize this discussion between corporate earnings and what what our index target will be, right? So as I previously mentioned, we've revised our earnings forecast this year to 30%. This cut was made ahead of street expectations, which allowed us to position well in the companies that we like. Now that we have the uncertainty brought about by the Delta variant, our core strategy remains the same. We look for quality companies that are trading in deep value. Now, when we say quality, what do we mean by that, right? So we believe quality companies are those that have sufficient balance sheet strength to tide themselves over the crisis and even emerge stronger after the crisis, either through consolidations in their industries, through acquisitions, or through rationalizing their operations and their strategies, right? So, and this strategy not only applies to Alpha Op, but also applies to all the other funds that already delve into the larger index names. Lastly, in terms of the index, we expect this year to close at 7.3 to 7.4, which is flattish, a 3% growth from the end of 2020. But we think that the more substantial run will be in 2022, when we expect the index to end at around 8.5 to 8.7, driven hopefully by higher vaccination rate, which would lead to higher mobility and a more open economy. That's it. That's our expectations for equities.
Thanks, Al. Anything else for the other speakers? Would you like to add? Or
yeah, sure. For fixed income, just to supplement what El mentioned, basically, we expect a favorable macro backdrop for fixed income, given the anticipated decline in inflation for the second half of the year. I think the Delta variant is largely going to put a dampener on risk, but El mentioned that they're finding great companies to buy over for the long term. But for fixed income, the negative environment for the economy is actually good for bonds. The BSP may step in the form of liquidity injection or further monetary accommodation to remain supportive of the environment, and that should drive the yield curve lower. In terms of bond supply, the bond supply we're expecting is really more on the concentrated on the longer tenor bonds, 10-year and 20-year, and maybe some tenors in between. So overall, expectation of a steeper yield curve. The combination of monetary support point to a supportive environment towards the 3-year to 3-year to 7-year bonds and corporate bonds. So if you are holding these bonds, we anticipate a return of about 2 to 3%. If the economic environment deteriorates further, then we can expect higher return for fixed income, Philippine fixed income. And if you are looking to diversify your portfolio, or if you're actually afraid of the development, if you have the view of that we are in it for a worse environment, then I think buying a fixed income fund in Atram is a way to actually help offset your risks in your equity portfolios. Thank you.
Thanks, Devi. Evan, for multi-asset, how about you?
Sure. My colleagues already discussed their outlook for the Philippine assets. Obviously, for our portfolios as multi-asset, we invest both globally and in the Philippines. And for our purposes, we get their inputs, Els and Devis inputs for our exposure there. So actually, we have the same views. But now, what I would focus on is the global aspect, right? So we have 3 themes. I can discuss them quickly for the second half of 2021. First is that in general, we are going to be in a very strong growth environment in terms of GDP. So we're coming off from very low economic growth last year, as you all know. And at the same time, we keep having this supportive central banks, like what Devi mentioned, and supportive fiscal stimulus by the governments to help the affected citizens. And we think that's going to continue, especially in the US. So for the US and for developed markets, we think that it's going to be above average growth, but it's going to decelerate starting this third quarter. So what does that mean? It means that despite it being above, let's say 6% growth for the second half, the average growth is 2.5. So it's still above average. So it's very strong. But at the same time, from a high of 10% in the second quarter in the US, probably it's going to go to 8% in the third quarter and further down, like 5% in the fourth quarter. So it's going to decelerate. So that will have implications in how we manage risk. For an asset allocation, we remain pro-risk, meaning we are overweight in equities or neutral, and we are also overweight in alternative sources of risk. For example, we are now overweight in commodities. We have seen a lot of strength in the commodity sector, both in the precious metal sector in the earlier part of the year, and now base metals, so copper, nickel, and then you also see agricultural commodities doing well. So that positions help us this year, and I think this will help us again moving forward. I think commodities will have a great 3 to 5 years because of all the positive factors that are going for it currently. So having said that, that's pro-risk because of our above average growth. But the thing is, it's decelerating. So with that, what it's going to change is our sector preference. In a decelerating growth, what do you want to be exposed in more? It doesn't mean that we're going to be exposed in all cyclicals or all growth, but we want to have a balance. And it's just going to be in between that. Depends on where we are at part of the cycle, right? So in a decelerating growth, we would prefer a more balanced approach between cyclical sectors and growth sectors, as well as quality growth sectors. What are quality growth? Those sectors that have cash flows, strong moats that will give you consistent cash flow and increasing margins, even if in a decelerating environment, right? So that's for global equities. That's for in general. And lastly, in terms of geographic exposure, we are a bit neutral in the US because of that view. We are overweight more in Europe and Japan and ASEAN because of the reopening story. In China, we are neutral. And And I can discuss that further if you guys have questions about China because it's been correcting, but only a certain part of the Chinese equity. It's not all, but a certain part. But currently, just to quickly do global fixed income also, we are underweight global fixed income, but we prefer. We also use Devi's dollar bond fund as our preferred exposure there. We like their exposure of having neutral to overweight duration and very dynamic because as you all know, for example, the 10-year US Treasuries can go from 1 to 1.8 to 1.2. So it's very volatile and you want to have active management there. So to summarize our multi-asset portfolio views, we are overweight in equity still moving forward because of that growth, because of that fiscal stimulus and monetary stimulus that will keep on being supportive. And I think central banks can try to, taper, but they're going to be having a hard time. Since 2010, they've tried doing 2 tapers already, and it's bad in general for risk assets. But then they will reverse it, and then you go up again. So there are opportunities there. And then for fixed income, we're underweight asset allocation, but we prefer to being very dynamic in our portfolios while having good corporates, investment grade corporates, and sovereign bonds. And lastly, it's alternatives. We prefer alternatives. We like real assets like infrastructure. We like commodities. We like other assets that are not correlated with traditional markets, so that we can have this less volatile portfolio while still giving you that capital appreciation and income moving forward.
Thank you, Ivan.
That's it.
Thanks for that. Question that we have is for DJ for the Asia Equity Opportunity Feeder Fund. So in relation to that, can you also share your market views on Asian market for 2021? And how does this affect the strategy for the Asia Equity Opportunity Feeder Fund?
Well, Ivan covered a lot already on the global equities side, so I wouldn't really expand too much on it. But I would have to say that given that most of the globe is already 20% inoculated, and that already points to economies really opening up. And if you look into Asia, North Asia has been mostly successful in containing the spread of the virus. And it's really our ASEAN neighbors that got hit by the Delta variant. And it's going to be this continuous tug of war between the Delta variant and inflation concerns versus tailwinds such as vaccinations and loosening of quarantine restrictions, or in our case, tightening. But because of the interconnectedness of the globe, Asia really is a beneficiary. You can't see it as a silo. It's a beneficiary of global growth. And if that really happens, you want to be able to be in growth, but also stay defensive, as Ivan said. Go for those quality growth franchises. And that's what this particular fund really delivers. And how it really affects the strategy is it's going to be very positive for this fund, given that this is a fund that provides you both income and growth opportunities, as Ivan said. And because of the focus on quality and defensives, it's going to help you outperform during these volatile times.
Got it. Thank you for that, DJ. The next question that we have is for Ivan. So Ivan, do you recommend an increasing exposure to equity funds now, or to wait a bit, considering there's still negative news related to COVID?
Well, that's a good question and a very hard, complex answer. Needs a complex answer, but I will keep it simple. So first is we manage global assets, right? And as I mentioned already, different countries, different regions will have different opportunities and risks. And currently, when we combine all the factors that we watch for global equities and the countries that we look at, I mentioned that in Asia Plus, right? We look at macro fundamentals of each country, we look at earnings momentum, we look at flows, how investors are putting in their money. Are they flowing out of this sector or this country or in? And that's very important, especially in this kind of environment. So that explained, I would say that it is okay to keep on adding, especially if you have a long-term investment horizon. But at the same time, having said that, it's always good to add. And at least for me personally, you'd add it gradually. You don't have to put it all now, right? If you have your monthly income, you can save up to 50%. You can combine it in a multi-asset portfolio, combine it with Philippine equities, Philippine fixed income, or if you have dollar income, then you can put that also in dollar funds, right? Like our feeders. So I would say keep on adding gradually, do a dollar peso cost averaging. And then right now, the question is where are you going to add, right? So is it going to be what sector, what country are you going to add to? Because as I said, global equities are kind of, if you look at the valuations, especially US, it keeps on going on all-time highs. It's high versus its history. Obviously, there are other opportunities for us, like Europe, like Philippines. It's very cheap, especially if you now move forward towards next year. So that's an opportunity in Philippine equities. There's an opportunity also in hard hit names still. For example, we like Europe, right? Europe has been a very perennial underperformer compared to its US counterparts, because the US has been outperforming for 11 years since the GFC, because basically of its better infrastructure, better fiscal stimulus, better monetary, and they don't have much problems. But now Europe is getting better and it's cheaper and global growth is booming, and Europe is a beneficiary of that. So in general, add if you have a long-term investor now, gradually, and I think you would add in relatively cheaper names based on this current environment. So I would say Philippine equities, European equities, and if you like US, don't just invest in those companies that have no profits, because that's speculation and not investment. So you'd rather go for quality sectors or quality names, like those with have cash flows talaga. So yeah, that's as I mentioned, it's a very complex answer, but add gradually, add to names that are attractive, and not just blindly add to everywhere, because you have that opportunity with us. You have the capability to do so. So
okay. Thank you, Evan. Thanks for that. The next question is for Elle. So Elle, how should we compare Atram Alpha Opportunity Equity Funds versus other equity funds in the market? And not only in terms of performance, but as well as the companies included in the funds.
Yeah, hi. Thanks for that question. I don't really have the information and the top holdings for each fund out there, right? But I would guess that most of the funds, equity funds out there, would hold the large cap index names. While for Alpha Opportunity, we have a clearly defined strategy, as I mentioned earlier, that we have a cutoff in the market capitalization of the companies that we invest in, and that's 150 billion. Anything more than that, we don't really invest in, right? So, for example, our top holdings, which I think I can say because this is in the fund prospectus, would be like Wilcon, the likes of Wilcon, Converge. So typically these names you may find in the other equity funds, but not as their top holdings. Their weight would be minimal, since they would still be invested in like SM Prime, Ayala, the Ayala companies. But yeah, that's how different the strategy is for Alpha Opportunity against all these funds. And we think that this strategy works, right? Our fund performance speaks for itself.
Got it. Thank you. Thanks for that, Elle. This question anyone could answer. Given the volatility of the market and the economy, what can you see for 2022 and the probable funds you can recommend to us, especially to a new investor?
Maybe I can take that.
Okay.
So I think we're in consensus that 2022 is going to be a very positive year. That said, you'd want to be a bit more focused on equities rather than fixed income, and actually also different types of alternative asset classes as well, if you have the availability for that. But given the volatility in this period, and for a beginning investor, I think the better funds you'd want to be invested in are really multi-asset funds that are able to allow for a more risk-adjusted approach or less risk approach. So you could go to Evan's Unicapital Diversified Growth Fund, or you could invest into one of the two multi-asset funds like Global Multi-Asset Income or US Multi-Asset Income. You'll also notice that a lot of our speakers, including me, are very much focused on quality franchises. So you have a lot of our fund range that do provide for quality franchises like global tech, like Asia equity, and there's a couple more also. So focusing on those that provide for income and for defensiveness will always help in these trying times.
Thank you. Thanks, DJ. The next question is actually for you also. So what are your thoughts on the global technology industry? Will it crash in 2021?
That's a very complicated answer. I think if you want to look at it, there are a lot of headwinds. There's a lot of things that are pushing tech down, but also a lot of things that are pushing tech up. It's a tug of war. A lot of the volatility will help tech moving forward, given that that's going to be it's becoming a safe haven place for a lot of people to go to. With all the uncertainty, let's just go to tech. We know that tech is going to continue to help us drive growth. Let's go there. But at the same time, you'll also see that a lot of the software names are getting hit because of all these regulatory aspects in Beijing, in China. If you look at tech stocks in the US, they were also hit by the Beijing crackdown. So there's some contagion in that area. So it really helps to be able to go for a more quality fund when it comes to tech. And that's really what our global technology fund provides. As I said, we're not in a lot of the big stock names like Amazon, Google, Microsoft, Apple, whatever. Because they have reached a lot of new highs and high price multiples, or basically they've become expensive in the past few weeks, months. But how the fund really approaches it is looking for opportunities elsewhere, like retail, e-commerce, and the reopening. So it really looks for, let's just explain quality again, high recurring revenues and potential for long-term above average GDP growth, while avoiding more of the expensive stocks. So being able to focus on the quality names really also helped the fund. It actually topped up in Chinese internet names, very consistent. How Ivan was also looking at the Asia Plus. And it will continue to find attractively priced companies focusing on the fundamentals rather than just sentiment, which is driving the price of tech. So tech as a overall area, from fundamentals alone, it's solid. But there's just a lot of market sentiment factors that are affecting this sector. So you want to be in a fund that will be able to guard you from all these issues that the market is really thinking of right now in the tech sector.
Okay, thanks for that answer, DJ. The next question, any of you could answer this. How do you manage the risk of your fund portfolios? Do you use tools like the Sharpe ratio?
Hi, I guess in the equity portfolios, we manage the risk in two ways, right? First, in this company specific part. So we have a robust system that incorporates investment risks, everything that's associated with the company. So that includes either financial risks, any business risks, any risks that would harm the company's business model, and also the ESG risks, as DJ already outlined earlier. The ESG risk has long been a part of our investment process and our fundamental analysis. And we have refined our systems in place that now it plays a larger role in our fundamental analysis of a company. In terms of the portfolio, that would be one that we also take a look at the tracking error of the portfolio and the active risks that we take. When we enter into positions, we make sure that we don't breach our mandates.
Thank you, Elle. Thanks for that. Next question, in Atram's view, how will these top performing funds perform in the coming quarters? Any could answer.
Yeah, sure. I'll answer. I think I'll answer first because there's a lot of uncertainty. But I'll add first to what Elle mentioned about risk management. So basically, for fixed income, we really just manage our interest rate risk by controlling our duration and then do some selection on the yield curve. So basically, if of course the expectation is for lower interest rates in the next 7 months, we go higher duration, and we expect rates to go up, then we go shorter duration. I think given the volatility and economic uncertainty, so we've had a series of scare right now in the NCR that there's going to be a potential lockdown, and there's also we're entering the period where there's going to be a lot of typhoons as well, right? So that may put a dampener on economic activity, and just to support DJ, I think 2022 will be a very good year, but before we get there will be a lot of volatility, and if you want to protect yourself, I think Philippine fixed income is something that will be able to help you manage the risk. In fact, over the last 2 years, the Philippine fixed income, or our total return investment fund and the corporate bond fund actually generated return. So if you're going just for a pure GS portfolio, that's a positive 14% relative to a negative PSE index of about minus 18%. So that's actually offsetting a little bit of your risk. So I also support DJ that if you're a starting investor, go for multi-asset fund where it can dynamically change the asset allocation towards more fixed income or more equities. The timing really depends on the economic outlook in the short to medium term. Maybe Ivan can add as well on the management on the allocation.
You guys answered it all. But kidding aside, aside from all their answers, at least from our perspective, multi-asset perspective, and I might be speaking a bit philosophically here, is for us, risk is just really knowing what you're doing, right? If you don't understand what you're doing, then you shouldn't do it. So that's our main philosophy. Never risk anything, or especially clients' money that you don't understand. So we have to do our due diligence. We have to select our fund managers, their styles, learn politics, learn pandemics, right? And aside from that, more technical basis is diversification. You keep on hearing diversification, but it's really a very effective risk mitigation tool, right? You're not just invested in one currency or one country or one company, but you know that some things are just beyond your control. So you control what you can control, and then those that you don't control, try to mitigate that by diversifying and limiting the exposure. So you have two ways of controlling it. The one you can control, do whatever you can. Never just invest money if you don't know anything. And then those that you don't control, and that's a lot. And you do that by diversification. You do that by doing your risk mitigation techniques, looking at all your metrics, etc.
Okay, thanks, Ivan. Thanks for that. Just to wrap up the questions, any of you could answer again. With all these top performing funds that we discussed this morning, what is the best? I think
I'll take this one.
To answer, but go.
I'll take this one because it's a hard answer, and people who are tuning in might take this answer as a cop out. But the best fund really is the best fund for you. personally, it's my job to make sure that all of these funds, even the funds that these great portfolio managers are managing, are the best. And um, just to make sure that it's there, we do all the risk metrics and stuff. But what the best fund really is, the best fund for you, you have to really know what your investment objectives, what your investment goals are. You need to understand how much risk you want to be taking in terms of the portfolio. There are a lot of funds here that are very risk adjusted or lower in the risk area despite where it's investing. Or there are also like things that are like consumer trends and US multi-asset that are very actively managed to make sure that it performs really well despite the volatility. But all that aside, you have to really understand yourself. You have to understand where you want to invest. And also, as Ivan said, you have to understand what you know. Invest in things that you understand, invest in some things that you believe in, and those will be the best funds for you.
Thank you, DJ. Anyone would like to add? So I guess it's really in terms of your investment horizon, also your risk profile. Lots of factors affect what type of fund will be best for you. So I guess that's all the time we have now for questions. Just before we wrap up, any last words? Elle, Evan, Devi, DJ.
Yeah, again, thanks. I want to thank everyone, all the attendees, for the interest. Even if you don't sign up to our funds, which we hope you will. We hope that you've learned a thing or two, or to come something learned a thing or two during these sessions, and we hope that we've helped you make informed decisions in your investing, in your investment portfolios, or if you're new, whether you'd invest or not. That's it.
Sure.
Sure.
How about you guys? Yeah, Devi.
Yeah. Again, no, thank you for the participation. I think for starting investors, the easiest one is to start. No? So because once you start, you'll be more involved, and whenever you get more experience, you'll have the more curiosity in finding about investments. No, the best funds is really the funds that are invested. So no, you don't keep everything on your bank account. If you don't invest, then you don't become an investor. So I think that's what I can share. Thank you very much again.
Evan.
Okay, so I think it's really understand that your purchasing power, your peso, your dollar, is getting depreciated or devalued. So it's not going to buy as much as you can. So what you need to protect your wealth and your family is really invest, and invest properly. Depends on your circumstances, as they mentioned. And lastly, and this is to quote our president of our Atram Trust, is control the things you can control so that the things you can't control can control you. Thank you.
Really good quote. Thank you for that, Evan. Anything else, or we could end with that, no? Or
I'll say,
want to add, DJ?
Yeah, thank you for the continued support that you're showing to Atram funds. We can't be performing well without your support as well. So we want to make sure that we provide you the best products in the market. And this webinar really just shows you that we're working hard to make sure that we do the best for you. And we want you to stay tuned to more of the developments. We're not done yet. We're going to be launching more funds in the near future, so stay tuned.
Okay, thanks for that, DJ. So once again, thank you Elle, Evan, Devi, and DJ, and of course thank you to our audience. We appreciate you taking the time to join us today. I'm sure you guys are interested to learn more about how to invest in Atrum funds, so please tune in to know more.
Hello. To open an account with Atram, just visit our website at www.atram.com.ph. Here, you can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Seedbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or Atram Academy page. Thank you.
Again, if you have any friends who you think would like this webinar but are unable to attend, please feel free to share the YouTube replay of this session, or please tell them to visit our YouTube channel, Atram Studios. We would also like to invite you to join Atram's official Viber community group, that's hashtag AtramPH community, to stay updated on the latest announcements, advisories, and reminders. Please scan the QR code or visit the link http://bit.do-atramph and get a chance to win Atram merchandise. Lastly, we hope you could please take some time to answer the survey at the end of this webinar. We would love to know your thoughts on today's topic. And on behalf of everyone at Atram, thank you again for your attendance and participation. We wish you and your loved ones continued health and safety. Have a great day. Thank you.